Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Ben Poole, writer at CTMfile. Welcome back, Ben, to another episode of the Open Treasury podcast.
Thanks, Push. Always good to be on the podcast.
Thank you, Ben. We truly appreciate your time and insights as we explore critical topics and themes shaping the landscape of corporate treasury management, payments, and beyond. In today's edition, we shall discuss 4 topics, namely 93% of treasurers say forecasting inaccuracies led to avoidable losses over the past 2 years, Citi and Mastercard partner to transform global cross-border payments, Swift to launch AI-powered fraud defense for cross-border payments, and finally, KYC streamlining and payments fraud protection, keys to stronger corporate and bank ties. Our audience can watch treasury and payments videos on the CTMfile YouTube channel and explore insightful articles, interviews, and industry roundups on CTMfile.com either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with the first story. A significant majority of treasurers say forecasting inaccuracies resulted in avoidable losses for their companies over the past 2 years. As businesses grapple with disruption across multiple fronts, managing financial risk is increasingly complex, according to HSBC's newly released Corporate Risk Management Survey 2024. Treasury departments are under growing pressure not only to mitigate financial risks, but also to provide the stability that enables companies to seize new opportunities. One of the most notable challenges highlighted by the survey is the difficulty in managing foreign exchange risk, with 47% of respondents admitting that their businesses are poorly equipped to handle it. This vulnerability stems from volatile exchange rates driven by unpredictable geopolitical events, soaring inflation that distorts revenue and cost projections, and ongoing supply chain disruptions that disrupt cash flow timing. A staggering 93% of respondents pointed to inaccurate cash flow forecasting data as a persistent issue, leading to avoidable losses due to overborrowing or liquidity shortfalls over the past 2 years. Ben, you covered this story for CTMfile. From a corporate treasury perspective, does it concern you that inaccurate cash flow forecasting data has been a persistent issue for 93% of respondents, leading to preventable losses caused by overborrowing or liquidity shortages over the past 2 years? Additionally, is there anything else you would like to highlight about HSBC's Corporate Risk Management Survey 2024?
Thanks, Push. Yeah, forecasting is always top of the surveys of treasurers in terms of things they want to sort out in the year ahead. You know, all the annual surveys that come out, it will be in the top 3 because the fact is it should be, because you can't really get 100% accuracy in cash flow forecasting. But what you can do is make small improvements, push that visibility further out into the areas of payments and cash flow around the world that treasurers are dealing with. A lot of that is through digitization, of course, which kind of eliminates manual problematic entries if people are inputting data incorrectly, and just helping you get the information that you need when you can actually have an action on it, rather than finding out, 2-3 weeks later when it's too late to do anything about it. So I think forecasting will always be something that treasurers are continuing to focus upon. The report itself makes several interesting points, I thought. Firstly, the rising complexity that you mentioned in the introduction there, in terms of just the range of financial challenges that companies face at the moment. Obviously we've had interest rates shooting up and now starting to come down, but at a much slower rate than they went up at initially. Inflation looks to be sorted, but in some countries services inflation is still running quite hot. Fluctuating FX markets, as you said, that's always a big concern for treasurers in terms of the different currency pairs that they might be working with and getting cash back into their functional currencies. So treasurers have got all that to deal with, but also kind of looking at how some of these risks could also be opportunities as well. Companies want to protect themselves from the downside, but find ways to benefit when the market actually works in their favour. So that's what a sophisticated risk management strategy can help deliver for treasurers. It's not just firefighting, but it's also something that has become essential to keeping organisations on solid ground. And the HSBC report makes clear that this year the forces shaping those FX markets aren't just economic. Obviously, we've spoken before about the year of elections, which it is in 2024, and geopolitics is increasingly influential over currency values, the survey shows. So economic indicators are quite predictable, but political outcomes can be far harder to forecast. You just need to look ahead to November's US presidential election. There's polls that make it very difficult to figure out who's going to actually come out on top there. And that's just one example. So that makes it really tough for treasurers to effectively hedge FX risk, because they're not just trying to manage what's happening today, they've got to also prepare for the future when things could change at a moment's notice. So that's quite a big concern. And that ability to be agile and to respond to big changes as they happen is something that treasurers are quite used to. I think after the rapid interest rate hikes, for example, from a couple of years ago, when central banks were raising rates aggressively to control inflation, that spike led to higher financing costs for companies across the board, which is also a big risk. And that led many corporates, and specifically kind of led by treasurers, to look at their debt structures and try and find that balance between fixed rate debt and floating rate debt. So treasurers have been quite hard at work trying to protect their companies from the worst case scenario, while trying to get in the right position to benefit as rates, as we've now seen, are starting to come down. So really trying to find that balance between sort of offense and defense, I suppose, to use a sporting metaphor. And finally, I think another important thing in this report from HSBC was on ESG, that it looks at quite strongly. The report notes that ESG governance factors are increasingly getting woven into business strategies, but that there are challenges here. One of the big issues companies face is managing those supplier relationships, which often take years to build the trust with suppliers. And some companies are feeling the pressure to change partners based on ESG scorecards, according to the survey. So that's a really hard trade-off to make. Corporates need resilient supply chains. We've spoken about that before a lot as well. It's something that's top of mind for many, particularly trying to avoid concentration risk is something that's a big concern. But on the other hand, you do have this growing accountability to ensure that obviously ethical practices are being pursued throughout the supply chain. And that's not necessarily just your direct supplier, but it's who's supplying them and getting that visibility, and that's a risk as well. So I think the good news from this survey is that companies are stepping up and starting to make those quite hard calls in terms of pursuing that and showing that it is possible to integrate ESG considerations into their overall risk management strategies.
Ben, thank you for highlighting the key findings of the survey and your incisive comments around it. Let's now shift our discussion to the second topic, which is about Citi and Mastercard looking to transform global cross-border payments. Citi and Mastercard have announced a collaboration to offer cross-border payments to Mastercard debit cards in 14 receiving markets worldwide, with plans for further expansion. The initial markets are Croatia, the Czech Republic, Denmark, Hungary, Israel, New Zealand, Peru, Poland, Romania, Singapore, South Africa, Turkey, the UK, and the United States. Citi is the first global bank to enable cross-border payments to Mastercard debit cards using Mastercard Move. Ben, how do you see this partnership between Citi and Mastercard impacting the cross-border payments landscape, as well as Citi's treasury and trade solutions clients?
Yeah, it's an interesting bit of news, obviously, with the specific markets that you mentioned there. So it's not everywhere, but it is interesting that Citi are the first bank to kind of partner with Mastercard on this process. And actually, there's been some more news since then on the Mastercard Move side. With Sibos happening in Beijing this week, they announced that a development of Mastercard Move commercial payments, which is slightly different to the debit card relationship that Citi and Mastercard have there. This commercial payments side of it is designed to enable banks to facilitate near real-time predictable and transparent commercial cross-border payments, which hopefully could help simplify operations and optimize liquidity and cut down counterparty risk, and also give kind of that end-to-end visibility for the banks, but obviously most importantly for our listeners, their customers as well, so corporate treasurers. I think this kind of speaks to a bigger issue that the financial services sector has been trying to solve for a very, very long time, which is getting cross-border payments to have the same level of efficiency and visibility as domestic payments. That's something that has always been an issue. It used to be, 5-10 years ago, perhaps, it was effectively you putting your payment into a black hole and you had no idea when it was going to pop out the other side because you wouldn't see like the correspondent banking network that it was traveling through before it finally got to the person you were trying to pay or receive payment from on the other way around. So today that's kind of revved up with the faster payment systems that are coming through and always on availability that the more sophisticated treasurers particularly are looking to take advantage of. And cross-border payments have also been growing at double-digit rates, according to some data from McKinsey, particularly as businesses expand their supply chains and operations internationally. So despite that happening, banks are still having problems with various pain points that can be passed on to their customers through slow and unpredictable payments across border that particularly don't have the pricing transparency, which is a big issue for corporates. Bank costs are always something that treasurers are looking to find ways to trim down. So this could potentially be an opportunity for treasurers to do that. I mean, the solution, as I said, it promises near real-time payments, 24/7, 365 availability for banks to transform corporate trade payments and intra and inter-company treasury flows, where working capital efficiency obviously is crucial. And it includes settlement options to give banks more flexibility to optimize liquidity efficiencies. And they say it has no impact on FX and deposit-related bank revenue. So Mastercard are pitching this as it's not going to really affect what the banks are making, but it also could be good news for the corporates in terms of what they're paying. So that's quite smart. They've been able to kind of offer that to both sides of the same coin, if you like. So I think it's really interesting because it uses banks' existing investments in the SWIFT messaging infrastructure. It's got a single technical connection that allows corridors of currencies to be added without much cost or resource. And Mastercard also says it's fully compatible with its existing correspondent banking arrangements. So it's not disrupting, in the negative sense, everything that's already set up. And we mentioned Citi on the debit card side of the Mastercard Move thing, but on the commercial payments side, they have had a pilot for it in the UK with Lloyds Bank and UBS, which used Finality as the settlement venue. So now the solution is being used to deliver those anytime cross-border transfers. So that's really interesting, I think, on the commercial side, how you're seeing these payment service providers try and tackle the cross-border payments issue. And also on kind of the other side, this week on CTMfile, we reported on the Bank of International Settlements Committee on Payments and Market Infrastructures, who published 2 reports to the G20 with insights and recommendations on the interlinking and interoperability of national payment systems to enhance cross-border payments, kind of particularly looking at how to do this with the new breed of faster payment systems that many countries are up and running with now. And APIs feature quite heavily in both of those reports, kind of looking at how they can help in obviously connecting the systems, but also kind of judging how API technical standards are currently fragmented in a way that is stopping them reaching the potential here. I just think we've had a lot of stories this week, and I think particularly with Sibos happening, cross-border payments are very much top of mind for everyone in the financial services sector. So there's lots of efforts to try and improve the payment experience for banks and for their corporate customers from the commercial and regulatory sides of financial services. So hopefully, kind of bottom line, hopefully that spells better news for corporate treasurers when it comes to all the issues related to payment tracking.
Well, you made some great points, Ben, and I couldn't agree more. Next up, let's delve into the third story, Swift to introduce AI-powered fraud defense for cross-border payments. From January 2025, Swift will be rolling out an AI-powered fraud detection capability that aims to help the financial industry tackle increasingly sophisticated forms of financial crime. This enhancement builds on its existing payment control service and follows a pilot with financial institutions across Europe, North America, Asia, and the Middle East. The rollout is part of the cooperative's broader collaboration with its global community of more than 11,500 banks and financial institutions to test how AI can solve pan-industry challenges. According to Nasdaq's 2024 Global Financial Crime Report, fraud was estimated to cost the global financial services industry $485 billion in 2023 alone. To help solve this problem, SWIFT is harnessing AI to give financial institutions stronger and more accurate insights into potentially fraudulent activity. Ben, how significant is the rollout of SWIFT's new AI-enhanced fraud detection service for the benefit of financial institutions across Europe, North America, Asia, and the Middle East?
Yeah, I think it's hugely important. We've spoken before about the potential for AI to assist in treasury operations, but sadly the same is true for those with malicious intentions. Bad actors are using more sophisticated tactics to commit financial crime, and you quoted some stats there in terms of the impact of fraud. And earlier this month on CTMfile we covered a study from Juniper Research which was looking at e-commerce specifically, and found the value of e-commerce fraud will rise from 44.3 billion this year to 107 billion in 2029, with AI fueling the sophistication of attacks across the e-commerce ecosystem. Particularly, the research pointed to the use of deep fakes created using AI, which can actually defeat verification systems as a key threat. So obviously that's something that if AI is the weapon that's being used by malicious actors, then you need AI as part of the shield to protect the financial services infrastructure, I think. And yeah, with this announcement, SWIFT is basically saying that the global financial industry needs to raise its defences higher to make sure that customers can continue to transact globally with confidence, which you need. Otherwise, the whole system could just fall apart. The idea, I think, with the SWIFT program, as you said, is that technology will identify suspicious patterns in real time, reducing fraud risk and helping to ensure that safer banking experience. And yeah, we just mentioned about cross-border payments speeding up in the previous story. So I do think that on that speed side, that's really where AI comes into its own, checking these almost instant payments. And SWIFT itself recently announced that 90% of cross-border payments sent over its network reached the destination bank within an hour. And that speed of processing is even above the G20 target of 75%. So I find that really interesting, and it's all fits in with the kind of the acceleration of finance that we're seeing in so many different areas, and how real-time or almost real-time, it's happening in payments, but the knock-on effect for treasurers specifically is in so many different areas of that. So basically, I think it's crucial that SWIFT is looking at these new and emerging technologies to help shore up the defences that already exist and kind of build on those stepping stones that are already there to create a better defence.
Ben, thank you for enlightening us with a fresh viewpoint on the significance of SWIFT's new AI-enhanced fraud detection service for the financial industry. From SWIFT's new fraud detection service, let's move to the fourth news story, which is about KYC streamlining and payments fraud protection being keys to stronger corporate and bank relationships. 92% of corporate practitioner respondents consider the customer service responsiveness from their banks to be either a very valuable or valuable aspect in their primary bank relationships, with 3/4 rating this factor as very valuable and an additional 18% rating it as valuable, according to the Association for Financial Professionals, or AFP's 2024 Bank Relationship Management Survey report. Among the key findings of the AFP survey is that more than half of the survey participants believes banks can fortify or strengthen corporate relationships by streamlining the Know Your Customer or KYC process and safeguarding against evolving payments fraud. Streamlining the KYC process is viewed as a higher priority for organizations with operations across multiple regions and for larger companies with annual revenues of US $1 billion or more, compared to firms based in the US and Canada and those generating less than $1 billion in revenue. In addition to streamlining the KYC process, corporate treasury and finance professionals are progressively focusing on securing their organization's payment systems, as payment fraud is expected to continue its upward climb. To combat the growing menace of payment fraud, corporate treasury and finance executives are actively turning to their banking partners for enhanced support. Ben, organizations today demand more than basic banking services. They're looking for trusted strategic partners who can meet their complex business requirements as streamlining the KYC process and payments fraud protection. To keep banking services aligned with operational needs, do you think treasury chiefs and finance leaders must continuously assess their banking relationships and seek improvements when necessary?
Yeah, I think it's beholden on them to be doing that, to make sure that they're regularly reviewing bank relationships and just making sure they're also seeing what else is out there. Not just, oh, this is fine, I'm happy with this, because there might be something better out there. We know that it's but the global banks in particular are hugely competitive with each other. So often if one comes out with something that's quite new and interesting, you'll see different versions of that pop up in some of their rivals quite quickly afterwards. But I think, yeah, it's beholden on treasurers to do that. On this specific story, Push, which I thought was really interesting, is the KYC point, because this is another one of those issues that since the dawn of time almost, treasurers can be hugely frustrated by. Particularly today, though, I think it's almost heightened frustration because of all the benefits of digitalization that we're seeing across corporate treasury. Some processes are held back by paper-based regulatory requirements. There was one treasurer I was speaking to earlier this year who was properly at their wits' end with how much time they have to spend on things like KYC, FinCEN, FACTA, FBAR, and like a form might need to be recertified and require an original signature, which this treasurer was saying could mean they have to print the form out, sign it, and fly to Switzerland from the US with that bit of paper. That's not efficient. You know, it's understandable why you'd be pretty angry if you were having to do that just to maintain or open a bank account. And compounding those challenges is that inconsistency in bank requirements around those data processes. You know, some banks will let treasurers do a digital signature, others a scan is okay. And then again, for some treasurers, it'll have to be a wet ink signature and then mail it in if possible. So I think that's an area where there's a huge opportunity to digitize. Another treasurer I spoke to on this topic had noted that they're an operating signer on hundreds, if not thousands of accounts globally. So they were asking, why can't they have more of a digital identity on the blockchain? So, you know, they can have ID items like their passport or driver's license and a utility bill for updating accounts. And it's an area where treasurers find the whole KYC and, you know, AML process, they're both hugely important processes, but they are so archaic in some respects. So identifying data that banks need to complete KYC, such as perhaps the company's legal entity address or tax ID number, those are very static data points. So these regulatory processes could be simplified for treasurers. You know, if a bank could digitize an entity, you know, when the time comes to complete KYC, it could be done relatively quickly. And banks that can come up with a solution like that would definitely have some very happy treasury clients, I think. But just to your main point off the top there, Jim Cates, who's the current president and CEO of AFP, noted about their survey that organisations are looking for more than just banking services. They are seeking those trusted strategic banking partners who can support their business needs, which are, you know, increasingly complex in the modern world. So I think there's plenty for global transaction banks to be thinking about in this space and how they can better serve their corporate customers.
Well, that's an intriguing argument and analysis you presented, Ben. Finally, Ben, what is your choice for the biggest or most important story of the past week and why? Is it rate cuts, US presidential elections, armed conflicts going on in different parts of the world, one of the stories we've discussed, or is it something else?
Well, I've tried to keep my head in the financial services sand rather than go too much beyond that. I was thinking about this before we started recording, Push, and one thing that struck me is the two of the biggest conferences of the year are taking place as we speak. It's 22nd of October that we're recording this. We've got Sibos, which is happening in Beijing for the first time ever, and also the AFP annual conference, which is going head to head with Sibos for the first time that I can remember, in Nashville, Tennessee, where there's obviously great representation from our colleagues at Strategic Treasurer, who hopefully many of our listeners in attendance at AFP have been able to see. What I would say is, banks and treasury tech vendors often use conference season to launch big new projects or solutions that might have a significant impact on corporate treasurers. So this is a great time to kind of check in with those partners and see what's new, see what new offerings they have that could be beneficial to cash and risk management. Also, it's a big time for strategic visions that banks can be setting out. And the big story that I've heard today is HSBC splitting its entire structure into Eastern and Western Hemisphere units. The BBC was reporting that the bank will create separate business units in the UK and Hong Kong, and there'll be 2 other operations, corporate and institutional banking, and international wealth and premier banking. And businesses in those operations will fall into either Eastern markets, which is Asia Pacific and the Middle East, or Western markets, so UK, continental Europe and the Americas. So that's something that multinational corporates might want to find more out about in terms of what happens to their support from the bank, because obviously multinational corporates will have operations covering both of those hemispheres. So what does that mean to them? Who are they dealing with? What happens to the relationship management, for example? So that's something that I think is pretty big news. I guess in some respects it's understandable when you look at the geopolitical situation today, but also maybe it's a step too far perhaps in kind of adopting a kind of a 2-hemisphere approach. But, with the conferences, we'll be covering some highlights on the CTMfile industry roundup every day as always, so do check out the website. But also, I just encourage our listeners to make sure they're speaking with their providers just to ensure they're not missing out on any developments that could really help support their treasury.
Those are wise words, Ben. And just to add to what you said, it would be a great idea for our target audience to visit the website of strategictreasurer.com and download the latest guide, which is the definitive guide to treasury technology, the Treasury Technology Analyst Report for 2024. It researches new treasury and finance technology, which at times can be overwhelming, but Strategic Treasurer has stepped in to help. So please explore the guide, help you understand the treasury technology landscape and discover detailed and data-based coverage of treasury and risk management systems, treasury aggregators, supply chain finance, and cash conversion cycle solutions. You can download the report by visiting strategictreasurer.com. We've come to the end of this podcast episode, and thank you ever so much for your insightful and informative analysis. We'd also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.